Knack?
Yeah. There's something. Yep, I'm ready to go.
Cool.
Let's do it.
Awesome. Griffin, if you don't mind muting yourself, that'd be great, my friend. Thank you, sir. Awesome. Well, as always, guys, thank you for joining. We appreciate you tuning in with us on this beautiful Saturday. We greatly appreciate your time. We greatly appreciate your attention. Today, we are going to be going into aggressive versus conservative day trading. So this is a topic that is widely discussed in the server, obviously because we have some conservative and some aggressive day traders in here. So in this class, what we kind of aim to break down is some rules to follow for either side, kind of help identify which side you're on and what suits best for both. So thank you for joining. We're going to get right into it. Oliknak, would you like to start us off?
No, you should start us off with the first slide.
Okay, sounds good. Well, there are traits of aggressive traders and there are traits of conservative traders. There is really no line in the sand. Some people will have all the traits of an aggressive trader, and some people will have traits from both sides of the spectrum. We always say that trading is highly individualistic, and this is the same principle. No one can really answer how you are and how you will operate. Only you will be able to find out which side you lean, conservative or aggressive, or maybe a mix of the two. And there's also no right or wrong here. Oftentimes, conservative and aggressive approaches have similar long-term returns should the trader just be profitable. This is due to the distribution of wins and losses, which we're going to get into in a couple of slides, and the risk-to-reward ratio associated with both styles. Some styles will perform better in different market conditions, which is something absolutely worth noting. For example, in trending markets, the entries will definitely favor a more aggressive trading style, I would say, and in sideways or less directional markets, conservative or more selective styles may be favored. You can ideally sway between the two depending on the market volatility, depending on what you're seeing happen. Choose between which one you want to use. Austin, Ben, what do you guys think? There's really no line in the sand here.
Right, and I think even a better name for this slide would be there's no right or wrong way to do this, right? We're just kind of identifying different ways of kind of, navigating the market and trading it, right? Logan's correct. The long-term returns, the returns in general can be very similar. It's just about what works better for you and understanding what kind of trader you are. So, yeah, we're just kind of here to differentiate the conservative versus aggressive style in trading.
Absolutely.
Yeah, absolutely. Yeah. And just to add to it, I mean, we kind of, investors look at this in the context of an active or a passive investor. So we want to kind of like apply this to the day trading realm. And that inherently makes it a little bit less absolute, which is kind of like what Logan pointed out. You can be some days an aggressive trader or a conservative trader. You can treat certain trades as more aggressive, as more conservative. There's a lot of factors that go into it. But to understand it, you're going to have to do a lot of self-reflection, which can be tough sometimes. But I think with the help of things like journaling, write-ups, etc., it might be a good segue into getting that integrated to your routine.
That is a fantastic point, Ben, and that's something that I like to always talk about. But no, definitely. Once you can kind of journal, find out exactly what you're doing during the day. Journaling during the day really does help because it shows you how you react to different things. And obviously, nothing in the market is really going to happen the same time over and over again. So seeing how you operate during different situations is going to help figure out, all right, am I more aggressive? Am I more conservative? When am I more aggressive? When am I more conservative, etc.?
Very good. So now we're going to get into kind of just chopping down the differences between these types of traders. Starting off, we have the aggressive trader. Pretty simple. We're going to go over the characteristics and the risk management that comes along with these things. So starting off with the characteristics, oftentimes does not wait for a higher time frame confirmations, right? We're seeing a lot of aggressive day traders really looking at smaller time frames, such as the 1 minute, the 3 minute, 5 minute, and even the 15 minute. They're not going to be looking at higher time frames like the 1 hour or the 4 to confirm, right? They're going to be, they need just those smaller time frames for confirmation, and that's it, right? Very, very aggressive trading style. They have strict exit rules due to smaller window of invalidation, right? So if you are taking on these very, very aggressive trades, you're going to want a tighter stop loss, right? Because, let's say you're aggressively scalping SPX on a 0 day, you're going to want your stop loss to be rather close, because if it's not close, you're going to lose more than 50%, 60%, or even like 80% of your contract value. So typically aggressive day traders will have a tighter stop loss. That's not always true, though. Sometimes being more aggressive could be a larger stop loss, right? So it can be interpreted a few different ways, but in this example, that's how we're viewing it. They also try to catch trend reversals, right? Very aggressive in trying to time tops and bottoms. And right, due to this, right, in nature, timing tops and bottoms is very difficult. They potentially have a lower win rate, but that does not really matter because they have higher risk to reward trades. So even if they lose, say 6-7 trades in a row, the moment they win one, they're back green, and it makes all their money back from those other losses, right? So very good risk to reward ratio in the characteristics of an aggressive day trader. Risk management, oftentimes the stop loss is dynamic to adjust for volatility, right? We talked about exit rules earlier that can be a little different depending on what kind of setup you have. Sometimes aggressive traders are willing to put the entire contract's value, for grabs. They'll be very, very aggressive, and with those close expirations, they're ready for some serious volatility within the contracts, right? So, you're trading 0-day contracts or even weekly contracts for that matter. It's not abnormal to see, to have some stuff run away from you sometimes, especially if you don't have a hard stop loss. So, yeah, that's just what it is. Usually closer expiration contracts, you guys heard me mention multiple times throughout these examples, 0-day SPX. That's just like kind of the classical, very aggressive trade. But, any like very close expiration contracts are going to move much more rapidly than ones farther out, right? And we have other educational calls talking about the behavior of option contracts, the Greeks, all that stuff. I encourage you guys to go check it out. But yeah, there's definitely a theme with aggressive day traders and closer expiration contracts. And they're, as we mentioned earlier, very into momentum trading and reversal trading, right? Going with the strong trends, chasing, right? Sometimes might be a good word to say, or trying to time tops and bottoms. So these are just some of the few characteristics of an aggressive trader, and you'll see when we go over the characteristics of a conservative trader, they are a little bit different. So
Yes, indeed they are. Something also that I would consider to be maybe more aggressive is, over trading or trading more in a day. That's usually a characteristic as well.
And one last thing, if I might add, I think one term that I just want to make very clear is that aggressive trading is not interchangeable with gambling. Many people might use that interchangeably, but they're just different styles. That's all it is.
Exactly. Going back to our first slide, there is no right or wrong. There is no line in the sand. Both sides have their pros and cons, for sure.
You can absolutely gamble, but regardless if it's aggressive or conservative, it's gambling.
Right. Gambling isn't either of these things, right, guys? Like, if you're just, randomly trying to just go short during a very strong uptrend, that's not aggressive trading. That's just gambling, right? Very clear differences.
Key word in this title right here is trader, right? We're not saying gambler.
Right.
Yeah, absolutely. Cool. Moving us into the conservative trader characteristics. So, a lot of the time you will see with conservative traders, confirmation is key. And, you'll hear me say this a lot. For example, I'm always waiting for a 15-minute candle close. That's my confirmation. So conservative traders typically wait for confirmation of a given setup, potentially on higher time frames, kind of like what I just said. Even if you're looking at a different setup, it could be a 1-hour chart, it could be a 4-hour candle close, whatever. It might even be a daily candle close. Whatever time frame you're looking at, you're looking for that confirmation. Focus is placed on minimizing risk rather than capturing upside. So while we were saying the aggressive trader has a potentially lower win rate, higher risk to reward, the conservative trader is going to be the opposite of that. A higher win rate, but a lower risk to reward ratio on average. And some characteristics, this should actually say risk management. Often the stop loss is set and not moved. Not all of the contract's value is usually at risk. Again, sometimes that could change. No line in the sand. If you're a conservative trader, you still may risk all of the contract's value if the expiration is close, for example. But most of the time, when you're a conservative trader or following some conservative characteristics, you're day trading with farther out contracts, maybe later in the week, maybe 1 week out, maybe 2 weeks out sometimes, and just trading those in the day as well. And also, instead of looking for those tops and bottoms, they're trying to follow the trend primarily.
Yep, absolutely. And the biggest difference between the conservative and aggressive day trader, in my opinion, is the risk to reward ratio.
Yes.
Would you say that's more or less what it is if we were to simplify it?
Absolutely. Yeah. And if you don't mind, I could just quickly go over this next slide. Go ahead. No, I'm just going to say this is something that we actually brought up in one of our trading psychology calls when we were talking about the player approach versus the house approach. And I actually think that really coincides well with our topic today versus conservative and aggressive. One side has higher win rate, lower risk-reward ratio, and the other side has the opposite. So, again, they can both be equally profitable because of the distribution of wins and losses. This side is going to have bigger wins, smaller losses, but more losses. This side has a lot of wins, but smaller wins, and then some larger losses. But then again, they both come out to the same 23R profit. So again, neither side is necessarily more or less profitable. It's just different how the distribution of wins and losses plays out in your trading.
Yeah, this visual is pretty good. I hope everybody's able to understand that.
Cool.
Okay, so now it's story time, right? This is a story about John. We have a story about, I think, 3 other individuals that were trading this past week, SPX. But yeah, here's John. John is an aggressive trader. He trades SPX because the premiums move quickly and allow him to effectively scalp. He understands the risk of farther out the money contracts and the impact of theta, which is time decay on the contracts. Sends in the market order for a daily contract or a 0 day till expiration, 0 DTE, to utilize larger volatility, cheaper pricing, and have a more efficient entry. He primarily pays attention to the 1, 3, and 5 minute charts, right, to gain insight. And that's typical of a very aggressive trader. They're going to be looking at those smaller time frame charts. And, in the example here, right, he spots a break of the daily resistance on the 3 minute chart and is looking for a retest of that resistance to enter a long position. If price goes below his stop loss for a moment, the trade is considered invalidated. So this is actually a trade that was executed on not long ago. This is from SPX. But you can see how price was rejecting from the resistance shown, and I have it by the red circles. We finally had a breakout, right? And John could have went long on that breakout too. That would have been a fine trade. But in this case, John was better able to kind of set his stop loss during the retest of that trend line. So you can see price came down. John set the stop loss very, very tight to where price was, right? And sure enough, it bounced and it had made for a wonderful risk to reward trade. And you can see the multiple take profits that you could have considered being an aggressive trader, right? Locking in that green and going with it. So yeah, this is a wonderful visual of an aggressive trade on SPX.
Definitely, using some very nice technical analysis. And I just wanted to quickly bring up, if nobody's familiar or someone's not familiar with risk to reward, it essentially means how much multiples of risk do you have to your reward. So if you're risking $500, for example, and you can gain $1,000, that is a 2-to-1 risk to reward ratio. And in this example, Austin so beautifully gave us, it appears to be maybe a 3-to-1, even maybe a 4-to-1 risk to reward. Yeah, 4-to-1 risk to reward ratio. That is a great trade. If you can hit a 4-to-1 trade, that's exceptional, really.
Yeah, and if you were super aggressive with it, it could have even been more because you could have just ignored those take profits and been like, you know what, I'm going to stay in this trade until it invalidates or something like that, right? And it could have even went higher. But that wouldn't be too smart, but it could have worked out in your favor if you thought that way here. So pretty cool chart.
Definitely. Like this trade.
Real quick, Austin, I just wanted to add to it. I think the key difference, and it's ties into what we spoke about previously, and you guys will see it in another example, but this type of trader will look for a pattern that's developing. So, while it's not necessarily a confirmation, if it goes below that support line, that trade at that very moment in time is invalidated. It doesn't necessarily mean there won't be a re-entry, maybe later in the day, but it just means that at that very time, the trade is invalidated. But we could see in this case that worked out pretty well.
Yeah, that's actually an amazing thing that you brought up. So going back to what you said about confirmation, if this was looking through a conservative trader's mindset, you would probably wait. You guys can see my cursor, right?
Yep.
Yeah, so you would probably wait for this candle push off on the 3 minute, and then once you got that candle close is when you would say, all right, we got confirmation of this level rather than just touching it. Now I'm going to go long. So the risk to rewarding that example, you would have a higher win rate, right? Because you're already seeing that we're respecting that level, but the risk to reward would be cut in half, if not more. So definitely a good point to bring up. If you're not getting in there,
depending on your entry, I did raise to showcase where an entry might be. You see right at the top of the red there, it's a little bit off of the trend line, right? So yeah, you would want to see price respect it to some extent before entering, but absolutely.
Yeah.
Precisely.
Okay, next story we have is Jenna. Jenna is a little bit different than John. She is a very conservative day trader, and kind of goes about the market a little bit differently. So she is trading SPY because she can buy dated contracts with higher moneyness, courtesy of Ben with that very nice term, at cheaper premiums to accrue smaller gains and smaller losses over intraday price action. She primarily pays attention to the 15, 30 minute, or 1 hour time frames for confirmation of a setup. Right, as we mentioned, one of the big differences between conservative and aggressive traders is the time frames that they're viewing, right? So this is a little bit of higher time frame, and this is like what Logan said. He likes to look for that 15-minute close. This is kind of in that boat with Logan. So She identifies the breakout of a bull flag. You can see that it was actually resistance for a few times there, and then we saw the breakout, aka the confirmation of the trade. Pattern was identified on the 30-minute and 1-hour time frames, as well as the 15-minute, which the trade was taken on. And the pattern will be valid until it breaks down below. And you can see that, yes, it did break down below, but I want to say in this example that there was actually a few opportunities to raise the stop loss and let price run higher. You can see the blue line I had there. Not only did we break out of the bull flag, but we also broke the high of that bull flag, which we held as support and actually pushed higher. So, you could have went about this trade in a few different ways, right? And raised your stop loss to squeeze more out of it. But yeah, nonetheless, this is a great trade. And, personally, I wouldn't let price go all the way back down to that breakdown level. But you could if you were being fairly aggressive with your in a conservative way, right? That's conservative. Yeah.
I think when we're viewing this example, that's a very good point. You would not want to see price come all the way back down because this trade worked out, right? You would have this be the stop loss if we break back down right after we broke out, for example.
Right.
But
correct.
I think if the trade's already working out, like Austin said, you definitely would want to trail your stop loss. And this example is great because you gave that example where we come back down to this blue line, retest the support, and then run up.
And that would be your new stop loss the moment, because as soon as we broke the bull flag, right, we broke up above that blue line as well.
Yes.
And then you're like, okay, we're above that high. That could now be a new stop loss for me. So that's where I would have a stop loss personally.
Yeah, exactly. And it could even be trailed up higher than that once we go, into this next little
and
impulse.
And you can see, right, because we're looking at a higher time frame chart, you can see those wicks that actually deviated below the blue line. If you're looking at a smaller time frame chart, those are going to look a lot uglier than what we're seeing right here.
Yep. That's another example of waiting for confirmation, looking at it from a stop loss perspective as well.
Yep, absolutely.
Cool.
Right, and just to add to it, I think one of the key approaches to this is the value of the options premium that this given person would be buying. So when we refer to moneyness, if you guys have read any options books or taken any classes, then usually what you'll see that referred to is how close to at the money or in the money that this contract would be. If the stock is trading at 20 and you're playing a $1 call strike, your moneyness is very high because you're extremely deep in the money. And vice versa, if you're, 25 strikes out of the money, your contract has no moneyness to it, and it's inherently worth nothing. But you can trade it in both ways. With a conservative approach, you want to be purchasing premiums that the values don't erode in a matter of seconds on a wrong move and on a 1 to 3 minute time frame. But yeah, just to add to that point, and also one more thing I think that might be important is that the reason that sometimes it might be hard to set technical stop losses on an aggressive approach is because of your theta, right? So like even if you say, okay, I will cut it at this point, but you're talking about 2 hours left in the market, that might not work out. And it's just something to keep in mind.
Definitely worth keeping in mind.
But if you have dated contracts and you got 2 hours left in the market, that's not going to be knocking on your door like that. It just depends on the approach.
Yeah, totally. Cool. So now we're going to go into some FOMC examples from actually our last FOMC meeting, looking at it from both an aggressive and a conservative approach. And now we are stepping into the shoes of Pat. Similar to John, Pat trades SPX because the premiums move quickly and allow him to scalp. Pat is a momentum trader, and on FOMC day, he prepares to take a directional position depending on the data's release. When the data comes out, a 5-minute candle closes in a direction, and Pat positions himself in that same direction, looking for momentum to continue. As you can see, we are on a 5-minute chart. Due to the volatility of 0 to 1 day expiration SPX contracts, Pat knows that he will most likely lose the entire contract value, especially around FOMC, around this time, or he will gain multiple hundreds of percentage gain if it goes into his favor. As you can see, we have our FOMC release. 5-minute candle closes. Pat enters here, sets a decent stop loss, but on FOMC that could obviously slip past your stop loss very, very easily. And you see we moved aggressively in the same direction as this 5-minute candle close, and Pat probably came out with a very nice gain, especially on some SPX contracts. Anything from the gentleman on this one?
No, I think that's another wonderful example of an aggressive approach.
I would just like to add some anecdotal approach to it, but I think that when it comes to being aggressive on FOMC day, I found that trading things like weeklies or zero DTEs, just very applied to this specific event, but it's pretty nuts in terms of like where your spreads go and how volatility will jump up and down. I mean, I've seen contracts go from $100 to $800 a piece in 5 seconds and be worthless a few seconds later. So you gotta keep a very focused approach if you're taking an aggressive trading style on FOMC day. Had a lot of good stories and a lot of bad stories from that, but
Definitely. Hence why it is quite an aggressive approach.
yes.
Cool. Going into the more conservative approach, we step into the shoes of Kyle. So, same situation looking at FOMC or another high impact data release. Kyle wants to play either the bi-directionally in the form of a straddle or strangle option strategy, or get confirmation of move after the volatility from the release ceases. In this situation here, Kyle knows that a high volatility event has a very high likelihood of playing out profitably in a straddle, meaning as long as we move in one direction, Kyle's going to get paid. So, using much lower risk than a normal position, because he is trading in a high impact news event, he takes a trade on both sides of the straddle. Kyle risks the entire contract because he's risking a lower amount. Funny enough, this is something that I do on FOMC day, but as you can see by this interesting picture that I had here, try to showcase the long and the short that you would have here, call and put side. One of the sides did pay, the other side may have expired worthless, but because they were trading 0 day or 1 day out, most likely the other side outweighed the loss from the other side. So yeah, that's just a more conservative approach to trading a high impact news event. Cool.
Okay, don't get mad at me for this one. But we're going to go over, I could not for the life of me think of higher premium contracts. We're going to go over this in a second. But what are the best tickers for both styles, right? So you often see how we're noticing, we're naming SPX or SPY or whatever. And there's a reason for that. It's because aggressive traders prefer to use at time larger premium for contracts, but also can trade at lower premiums depending on their goals to trade, right? So typically on these higher premium contracts, if you're playing farther out of the money, they're going to move very, very rapidly. Great examples of this is SPX, which is the S&P 500 index, or Tesla. Now, we had Google, Amazon, Shopify, all these other large share price names in there, but they all recently had stock splits. So I was trying to figure out, I was like, what other high share price equities do we usually trade? And these are the main ones that I can think of right now, just because everything's splitting, and I think the style of having a high share price is kind of going out the window a bit. But yeah, like maybe add Berkshire Hathaway to that. I don't know, but SPX and Tesla are the ones that come to my mind, right? Those aggressive 0-day contracts that are far out the money really, really move. On the other hand, you have the conservative traders who tend to lower their risk incrementally, so they will prefer contracts that they can buy a lot of and are fairly affordable. And you can see that, typically for this type of trader, they're going to be trading SPY, American Airlines, which is AAL, Apple, AMD, all these contracts you can buy right at the money, and they're rather cheap, right? So, that definitely fits the style of a conservative trader. Now, I should note that it doesn't necessarily matter what you're trading. What matters is where you're buying on the options chain. Typically, the reason why we associate SPX and Tesla with more aggressive trading is because people are buying very far out of the money contracts. If you buy SPX or Tesla at the money and buy a $3,000 contract, your contract's going to move just like an at the money SPY contract, depending on the circumstances and what the Greeks are in context, right? But the reason why we associate these larger, share price companies with that is because we're buying further out of the money, whereas on these other ones in the conservative, we're buying closer to the money because it's cheaper, right? And it allows you to do so. Now, if you have a multi-million-dollar account, none of this stuff really pertains. You could trade anything to its fullest extent. For people who are just getting started and really are trying to decipher, am I aggressive, am I conservative, what should I be trading, right? I know a lot of people were trading the airlines instead of SPX or SPY because they have very cheap contracts and it's kinder to newer traders. So I wouldn't necessarily consider the tickers for both styles, but rather how you're approaching the tickers for both styles. So, yeah.
Awesome.
I hope that made sense.
Definitely.
Yes, sir. Yes, sir. And if I might add, I think it's kind of a bummer that for the aggressive guys that we got all these big tech splits.
Yeah.
Well, they can still...
Austin?